Hi everyone, it's Hey John right here. I'm reporting to you guys today of why the stock market crashed today. And this is a great article on CNBC that explains it, but the real reason is because of one thing: bonds. Everyone is everyone is against bonds because of two reasons. A, because it's a safe haven, and B, because the markets are red hot right now, meaning that we're pretty much at our all-time high right here, right? And when you have bonds that are basically a safe bet, it's pretty much zero risk. It's almost guaranteed money for the most part. I mean, everything has somewhat risk, but everyone considers bond like a zero risk guarantee for the most part. It's kind of like putting your money in your bank in your savings account. It's almost guaranteed. You don't expect your 0.001% return or whatever it is, you know. With that being said, the bonds increased today by quite a bit today. The 10-year almost about 1.6, and that's essentially the same, very similar rate to pre-COVID times. And everyone in the government, Jerome Powell and all kinds of, they're all saying, you know what, guys, the markets are hot, the economy's booming, so that therefore we're going to raise the yields here. And the stock markets fell because people are going to. Why would you invest in the stock market right now when it's all-time high every time it's a peak, pretty much, to possibly get 3 to 5% here, when you can sell at the high, take your profits out, put it into bonds, and almost get a 2% or 1.5, 1.6 in this case return here. It's almost guaranteed, and wait for a dip and buy back the stocks again. You know. But the other reason is also how do you think the 1.9 trillion stimulus is going to be generated? You know, the money they generated through bonds. And currently the yields are 1.6, 1.5 right now for a 10-year. But when you have $1.9 trillion coming in stimulus, that means you're going to have a ton of more bonds coming on sale. So why would you buy today? You know, everyone's expecting it to be cheaper and with higher yields and higher yields in the future, by future, coming very soon. So with that being said, it's kind of a double whammy here. You know, people are moving out of it into cyclical markets. So Apple, Tesla, all the tech stocks they're all taking a hit. You know, they're all going down, and they're moving into cyclicals. You know, I guess commodities and those kind of stocks for the most part. But today was a bad day for stocks. It just went down, just a straight line down. It's pretty crazy. I mean, if you're in the markets today, you know, just hold tight. You'll be fine. Just gotta ride it out for the most part. Another thing to note also is that with these bonds increasing, it's you're also going to be fighting against inflation for the most part. Inflation is about what, 2%. So if you buy the bonds today at 1.6% and you have a 2% inflation, you're still upside down here for the most part. And that's kind of why everyone has money to put in the stock market, because it's a better hedge against inflation than current bonds. But the way things are shaping up, I'm pretty sure we're going to see higher yields coming in the future, possibly very soon. And everyone's expecting the 1.5, 1.6 rate to be at the end of the year, but apparently it's February 25th and it's already almost there already. So no one's expecting that. So what's going on here, you can see the chart here from CNBC as well for a 10-year treasury yield. It's indicative of what I was kind of saying here. We're almost pretty much at pre-pandemic levels, which is kind of surprising to me. I mean, it's kind of bizarre at the same time, but at the same time, it makes sense. You're seeing Etsy, Beyond Meat, all these large names coming out with, Etsy, they're all beating earnings for the most part. So it looks like someone's growing for the most part. So I guess the economy is red hot and booming, right? But at the same token here, you're seeing a lot of unemployment too, and nobody talks about that. You're seeing I think today, 720,000 unemployed on a weekly claims for first timers, and we've been having 720, 750, 900,000, 800,000 almost every week since the pandemic started, or February 20th of last year, around there. So it's I guess a tale of two cities, right? One says it's booming, and then the real economy is like, well, I don't have a job, man. What do I do? It's a bizarre world we live in right now. But yeah. So for me, I believe this is the reason, the sole reason of why the stocks are coming down for the most part. And obviously I have my 401k. I'm taking a hit as well. I lost quite a bit of money today, but it's 401k, right? You're not gonna touch it today. And obviously, I'm kind of young, so it's not a big deal. It sucks, but it is what it is. And there you go. If you found this information helpful to you, like and subscribe to my video, please. And I will be throwing out more videos in the future, kind of explaining these kind of things. Thank you so much, and I'll catch you in the next one.